Most investors never look at the cash flow statement, and that one mistake has cost people their entire retirement. Company can show billions in profit on paper, while its bank account is bleeding dry. The cash flow statement is the one document that tells you the truth. By the end of this video, you will know exactly how to read one in under 3 minutes and spot the 3 red flags that scream danger before you lose a single dollar. I can tell you the cash flow statement is where I look first every single time. Earnings can be manipulated with accounting tricks, but cash does not lie. Either the money hit the bank account or it did not. Every cash flow statement has exactly 3 sections. Memorize these because they are the backbone of every investment decision you will ever make. First is operating activities, the cash generated from actually running the business. This is the money coming in from selling products and services, minus what it costs to keep the lights on. Think of operating cash flow as the company's paycheck. If this number is negative year after year, the business cannot survive without outside money propping it up. Second is investing activities, cash spent on growing the business. Buying equipment, acquiring other companies, or selling off assets all live here. Negative investing cash flow is actually a good sign. It means the company is pouring money into its own future. You want to see a hungry company investing in itself aggressively. Third is financing activities, cash flowing between the company and its lenders and shareholders. Issuing debt, paying dividends, buying back stock, all of it goes right here. Add all 3 together and you get the net change in cash. That one number tells you whether the company's bank account grew or shrunk this quarter. Simple, but most people skip right past it. Now here is the section you absolutely cannot skip. Operating cash flow is the engine, and if the engine is broken, nothing else in the business matters. Compare net income to operating cash flow. If a company reported $200 million in profit, but only generated $40 million in operating cash, you need to ask where the other $160 million went. That gap is usually filled with receivables, money customers owe but have not paid yet, or inventory sitting in a warehouse. Neither of those pays the rent. Warren Buffett once said that operating earnings are what count, and he looks for consistent operating cash flow growth year after year. If the Oracle of Omaha starts there, you should too. Then you calculate free cash flow, operating cash minus capital expenditures. That is the actual cash the business can return to you as a shareholder after paying for its own growth. But here is the thing. Even free cash flow can fool you if you do not watch for the warning signs. And there are 3 of them you need to know right now. Red flag number 1, declining operating cash flow while reported earnings keep climbing. This is the number 1 warning sign of accounting games. I once analyzed a company that reported record profits for 3 straight years, but their operating cash flow had fallen 40% over the same period. 6 months later, the stock dropped 70%. Red flag number 2, selling off assets to generate operating cash. If a company is selling buildings or equipment just to keep the lights on, that is not a business. That is a liquidation in slow motion. Check the investing section for large asset sales. Then ask yourself, is this company a healthy business, or is it burning the furniture to stay warm? Red flag number 3. Consistently borrowing money just to cover operating expenses. Debt is for growth, not for making payroll. When a company issues debt quarter after quarter with no revenue growth to show for it, run.